Hello, Conrad. Good to see you.
Great to see you, Kai.
So the first half of 2023 is over. Time to talk about performance. Now our whole industry is facing strong headwinds. How is Clariant doing in light of this environment?
Yeah, well, some of our businesses are clearly doing better than the market. I'd like to recognize our catalyst business, up 30% versus prior year in the quarter. Our oil services business up high single digits, also performing really well. And finally, our adsorbent business, which overall also shows a very good performance in terms of revenues. Now, we're not immune for the macro environment. And if you look at the company overall, we are seeing for the quarter a -7% decline, -7% growth in the quarter. And this is basically 2% coming from divestments and 5% down from volumes. And then we were able to maintain our pricing, which I think in this environment is actually a good achievement.
So looking at demand, so what are the underlying factors looking at each of our businesses?
Yeah, if you look at the businesses where we did face demand challenges, starting with Care Chemicals, here we actually did see the effect from the divestment of our quats business, our North America land business, but we also saw significant destocking. If you look at the end user segments, they are actually holding up overall quite well. If you look at demand for cosmetics, for personal care, home care, crop protection, the end user markets are holding up pretty well, but there is a significant destocking, which we saw in the second quarter. If you look at the other area where we saw challenges in terms of our demand, our additives business, here there is definitely destocking as well, particularly with our plant in Europe supplying a lot of clients in Asia. There were quite high stock levels in the supply chain, and electronic products were actually tight last year in terms of supply constraints, not just from chemicals, but also things like chips. So there was definitely destocking there as well. But if you look at the broader statistics, for example, cell phone manufacturing down 18% year on year in the first quarter, and the industry forecasts are still saying roughly -14% down cell phone production in the second quarter. So here we still have clearly some demand challenges on top of the destocking.
Yeah, thank you, Conrad. When we talked about performance over the past few quarters, we typically talked about increasing raw material prices and how we passed these on to customers. Now we have the opposite. Raw material costs are coming down, which typically puts a lot of pressure on companies to lower prices. So is this a big issue for Clariant now?
Yeah, well, if you look first at our track record, this is very strong. So we have concluded 9 quarters in a row where every quarter we did achieve positive year-on-year pricing. Now, in the second quarter, for the first time now, we are flat overall with our pricing versus the second quarter last year. But let's keep in mind that it was very much needed to increase these prices to offset increased raw material costs, increased energy costs, increased freight costs. What we're now seeing is an environment where we see deflation in our raw materials. For the second quarter, it was a -12% versus prior year on raw materials and roughly -2% on energy and logistics. In that environment, I'm actually very pleased with the overall 0% on pricing for the company. It means we are actually holding our prices. It actually means we have a true specialty portfolio that does generate value to our customers that they're willing to pay for.
Well, that's certainly a positive view. Nevertheless, if we put together flat prices, lower volumes, there is obviously a negative impact on margins. So where do we stand with EBITDA, and what are other factors impacting EBITDA?
Yeah, indeed, our overall EBITDA margins did come down. Like you said, flat pricing, negative raw materials, but margins actually did come down from lower operating leverage, the -5% volume that I just mentioned. If you look overall, EBITDA margin for the company in the quarter came down from 16.6% last year in the second quarter to 16.1% this year in the quarter. Here it is a combination of underlying different performances in the businesses. I like to emphasize once again the great performance we saw in our catalyst business. If you actually take the biofuel results out, our catalyst business achieved an EBITDA margin of 21.3% for the quarter, so clearly significantly up from prior year. But we are also facing the businesses that are seeing volume declines. They are facing also declines in EBITDA margins. In Care Chemicals, if you do correct for the Quats divestment gain, our EBITDA margins are down. And actually, in our additives and adsorbents business, we saw quite a significant drop in EBITDA margins, down to only 7% for the quarter. And this very much volume related, very much focusing on the additives business for plastics components, but we also saw some declines in paints and coatings and adhesives additives.
Yeah, thanks for these insights. And maybe one last question on our past performance in a bit of a broader view. So when we communicated our midterm targets, we made a clear commitment towards more cash generation. We have never been very strong in this area. But despite the crisis that we see in the market, have we made progress in terms of cash generation in the first half of this year?
Yeah, so if you look at our cash generation, it has been very strong. Now, you mentioned this is indeed an increased focus for our teams. I'm very pleased that our operating cash flow is up almost 100 million Swiss francs versus prior year. We see clearly better working capital management, lower working capital as a percentage of revenue, but we also see more discipline in our CapEx spending, where we actually also are clearly targeting now lower CapEx spend for the year. And as a result, much better conversion to cash. If you start with EBITDA, there's much more cash left in the end.
Now, maybe a question on the outlook, which we just updated. So we said we would achieve a margin between 14.3 and 15.1% for full year 2023. After 6 months, we stand at 15.0%. So could we say it's a home run to simply maintain this level, or how do you see the second half of the year developing?
Yeah, it's certainly not a home run, Kai. So we should keep in mind that in the first half, we did have some incidentals, some positive effects. Most significantly in the EBITDA number, there is the gain on the disposal of our Quats business, which we divested. That won't come back in the second half. So in reality, our outlook means a better EBITDA margin that we need to achieve in the second half. There is a basis for that. We obviously analyzed the different businesses in terms of their outlook. What you see and what we expect is actually continued strong performance in catalysts, where there is a strong order book, and we just need to successfully deliver this order book in terms of shipments to our customers. We also see sequential improvement in revenue, in volumes already in Care Chemicals. We saw that in the first quarter, sequentially up from the fourth quarter last year. We also saw that in the second quarter, sequential improvement. We see the same in our adsorbents business. In additives, we're still struggling. We don't see the sequential improvement yet, but we know that demand at some point will come back. We're still being challenged with this bigger topic that there is a shift in consumer spending, where people spend much more on entertainment, restaurants, hotels, travel, much less on durable goods. At some point, this will rebalance, and also the volumes will come back in our additives business.
Yeah, thank you. There's one challenge that I would like to briefly discuss with you. So it's a sunliquid. It's a ramp up of our first of a kind production plant in Romania. Where do we stand now, and what can we expect specifically for the next few months?
Yeah, I would really like to recognize and thank the task force that is working on the continuous improvement in relation to the ramp up of the new biofuels plant in Romania. What we saw in the quarter is still a loss of 10 million from this operation, but I like to highlight that this is actually down from a loss of 13 million in the first quarter and a loss from 20 million in the fourth quarter last year and roughly a similar number in the third quarter last year. So we clearly have been able to cut the losses in the run rate in half, and we are targeting continuous improvement.
So maybe another point regarding the outlook. So when we issued our guidance, like many other companies, we highlighted that we expect a recovery in the second half, mainly driven by China, so rebound in China. So obviously this recovery is a bit slower than expected. So where do you see our performance in China now, and especially also in the months to come?
Yeah, to your point about the recovery in China, they actually just published some numbers. Their GDP only up 0.8% in the second quarter versus the first quarter. They're still running at a 4-5% improvement versus prior year in GDP. That is their outlook for the year. Now, we should keep in mind that last year's GDP was obviously a weak one because, for a big part of the year, the country was in lockdowns. So then if you put it in that perspective, the 4 to 5% growth is clearly a much weaker figure than we were used to. I think another comment to make on China is, and also when we look at our business, we didn't see the big destocking effects in China because there was never this inventory build to begin with. So what we're seeing is real underlying demand, and then that is actually weaker than it has been historically. I think to put it in perspective, China sees a similar challenge that we see in the Western world, where there is a clear shift in consumer spending, where actually consumers do not spend as much on durable goods, also have spent a bit more on services, on restaurants, travel, entertainment. So that is also something that will rebalance at some point in time. And mid to long term, all the fundamentals are still intact, and there should be a solid recovery in demand and also a recovery in industrial production in China.
So Conrad, to summarize, what is it that makes you confident to achieve our short-term and also our mid-term targets?
Yes, Kai, I'm confident about our short-term targets and our mid-term targets when I look at the results that we actually achieved in the second quarter. We had two priorities. The first is very much to maintain pricing in an environment that has become deflationary. And I think with the overall flat performance on pricing versus Q2 a year ago, I think we're on a good track there. Secondly, if you look at the decline in our volumes, we're also very much delivering on the cost savings initiatives. We had announced earlier in the year 160 million savings targets. We have delivered 107 million Swiss francs already against that target. And this quarter, we increased our target to 170 million, also very much looking at the cost in our operations. So putting these two together, I'm convinced that when volumes come back, and they will come back, that we're actually going to see margin expansion from much better operating leverage. We will actually be able to come out of this crisis situation much stronger than when you compare it with when we were getting into it.
Good to see your optimism here. Wishing you and all of us all the best for the next quarter. Have a good day.
Thank you, Kai.